So the thing on my mind this week is the stock market weakening? Is it getting weaker even with the price going higher? And if it is weakening, where is it specifically weakening? So stick around, I'm going to show you if it is or isn't weakening and how is it weakening and will it affect your portfolio for the rest of the year. All right, let's get to it. Hey guys, this is RC Peck, and I want to talk about just all the instability that's going on right now. There's a lot of instability right now with the Delta variant, and I want to bring the Delta variant and COVID into this in regards to the stock market. And really, let's talk about this instability that's happening. Now, I have an article over on the screen that I want to read to you, just a couple paragraphs. It's from the New York Times, and that's very apropos to what's going on. What I'm going to show you in this video are price charts of whether the stock market is weakening or it isn't weakening. And if it is, where is it? And when do we see those cracks, potential at 10 to 15% happening? So we're absolutely going to get to the price charts. Let me just read this. This is from August 22nd. And basically, let's see what the title of this is. The US is getting a crash course in scientific uncertainty. Okay, no worries. So just listen to this. When the coronavirus surfaced last year, no one was prepared for it to invade every aspect of daily life for so long. That's one thing, like, I think as Americans, we really thought, hey, we're going to get this, we're going to do this thing, and it's going to be out of here, and we're going to get on with our life. That did not happen. It's still here. We have the Delta variant coming back. Right? The pandemic has forced Americans to wrestle with this kind of life or death choice every day. For some people, it has been life or death. For the majority, it hasn't. And that's where it becomes elusive. Scientific understanding of the virus changes by the hour, it seems, right? The virus spreads only by close contact or contaminated surfaces. Then no, it's not that. It's airborne. Viruses mutate slowly. Then they emerge that they go faster. Now, I'm not dissing the scientific community, the CDC, the National Institute of Health. This is science. This is how science works. Right? Life is messy. We're figuring this thing out. Viruses don't sleep. They don't have a time clock. They don't care who you voted for. They don't care your background. They're going to figure out, that's what viruses do. They figure out how to survive. At no point in this ordeal has the ground beneath our feet seemed so uncertain. This virus has created a level of uncertainty. And if you've ever studied anything to do with the stock market, you know that uncertainty is what humans don't want. That's why people buy life insurance policies or annuities, because they see the word guaranteed. It's guaranteed. Now, you're only going to get 4% on your money, but that certainty of getting 4% on your money sells trillions of dollars of annuities and variable life and whole life policies. People strive for certainty. And that certainty, first of all, they're not asking the right questions about certainty, but that's what drives them to getting worse results. And I'm not even talking about only getting 4% on your money. So we know humans want certainty, and viruses don't care about our certainty. And so we have this pandemic going on that if it's done anything, whether you believe it's happening, have been vaccinated, have not been vaccinated, there's a level of uncertainty that is new to a lot of humans, right? It's outside of our control. Okay, so we are living in an area and a time of uncertainty. This is bringing me to the stock market, right? Because the weekly update is about the stock market. So let's talk about the certainty or the uncertainty of the stock market. Let me start by bringing up this price chart right here. This price chart is just looking at the S&P 500 divided by bonds. Literally, if the price chart is going higher, if the black line on the screen is going higher, that means the stock market is outperforming the bond market. So the simplest measurement of stability or certainty in the markets is basically saying, hey, which one's growing faster? Which one's doing better? And if the black line on the screen is going higher, that means the stock market is doing better and there is certainty, there is stability in the market. So this is kind of our first piece of data, like, oh, got it. The stock market's outperforming the bond market. Now you can look at the screen here and you can see there's periods where the stock market underperforms or where the bond market outperforms. When you see the black line fall, there's the COVID crash. That's uncertainty. And you can kind of see from there to there that there was this level of certainty, kind of 2018, 2019, and let's call it the first half of 2020. So we had 2.5 years of uncertainty, and our brain gets used to uncertainty and we think, oh, we're just going to have more uncertainty. So that's called recency bias. We think more uncertainty is going to happen because we just lived through 2.5 years of uncertainty. Now, this is a price chart looking at the S&P priced in the U.S. bonds, right? So think of it this way. The U.S. stock market priced in U.S. bond units, right? And you can see that uncertainty between those two blue lines. So we are just coming out of uncertainty. We could even take this blue line and really move it to there, because it wasn't until this relative price chart really broke above, and that happened, call it November of 2020. That's not that long ago, right? That's about 9 or 10 months ago. So we're still in this like life is uncertain. It totally makes sense, especially with the Delta variant, right? It's a variant. The virus is figuring out how to survive and live. And this is what it does. It adapts. So we have to adapt too. We have to look at the stock market and understand what we're looking at. That's what these videos, these weekly updates are partially about. How to read a price chart, really understand how to grow your money better. Okay, now there's other ways to look at kind of the stability of the market. So let me quickly jump on these other ways. And I've looked at these other ways in the past. I haven't looked at them for a while. I don't know, maybe a year or something like that. So this is the New York Stock Exchange, NYSE, the common stock only new highs. So are there new highs in the stock market? And if that black top line, the squiggly one, is above this black line, then it's bullish. Now, the bottom one on these price charts I'm going to show you is the S&P 500 with dividends reinvested. So you can see we did get below the black line and there was uncertainty, but we're mostly above it. It comes down, it touches it every once in a while. It's okay to touch it, but you can see, generally speaking, there are new highs. New highs are happening. That's a bullish sign. So let's do stock market beating bond market. That's number one. Number two, are there new highs? Yes. So two for the bulls. Number three, are there new lows? Are new lows increasing? No, because if the black line, squiggly line, is below that flat, then we're okay. So we've got 3 for the bulls. We've looked at 3 indicators so far. Okay, again, this is the common stock only new lows. So it's kind of the flip of the one we just looked at. Oakley dokley. The next one, this is our fourth one. The S&P 500 percentage of stocks above their 200-day moving average. So what percentage of those 500 stocks, 504, if you count all the different shares, type of shares, are above the 200-day moving average? And the answer is, drumroll, 80%. 80% of the S&P stocks are above their 200-day moving average. That's bullish. So number 4 indicator, we have 4 bulls on how the market's doing. Okay, our 5th indicator we're coming up on now is what percentage of stocks in the S&P are above their 50-day moving average? And the answer is 63%. So 5 indicators so far, all 5 are saying bullish, everything's okay. I think I have 2 more to show you. Okay, the advanced decline line. So this is indicator number 6. So this is diverging. So this is our first sign of the market saying there is some weakening going on, right? So this price chart, we're looking at the top one. Again, I told you on all of these, the bottom chart down here is just going to be the S&P, showing you what the S&P is doing during this time frame. So it's right down here. Up here, this is the advanced decline line. We're looking at our 6th indicator. And there's divergence. So the advanced decline line stopped moving up on June 9th. So it's moving down. So that's that's going down and the stock market's going up. So that's called a divergence. So that's bearish. Now on the screen we have, let me zoom out. Let's zoom out just a little bit. And we really don't see a lot of divergence going on here. Here, the market kind of went sideways for this period, but the market went up. So this is really the first time in 3 years? Let's do 3.5 for good measure. That's kind of a standard range that I look at. So in 3.5 years, there was no divergence here. The advanced decline line was falling. The price was falling. The advanced decline line started diverging here. There was a small divergence here, and we had the COVID crash there. There was a divergence there, and the market corrected. So we have seen some divergences. We haven't seen a divergence this long. Now, this is not like the, oh my gosh, oh my gosh. This is the 6th indicator. So this indicator, the advanced decline line, is saying, hey, underneath the surface, there's some weakening happening. Don't be surprised for a correction, not a crash, not an end of the world, a correction. That was our 6th indicator. Woo. Okay, and let's just do one more. Let's just make it 7. So this is just called the S&P 500 Bullish Percentage Index. Guys, it doesn't matter right now what it is. Just know that if the black squiggly line, top part of the price chart, okay, if that's above the horizontal thick black line, that means it's bullish. If it's below, it's bearish. Now, this is what I want to point out to you. It was below here and the market didn't, crash. The world didn't end. It was below here and, the world didn't end. And it's below here. So it's been below. It's spent some time below. This indicator by itself is very noisy. Now, it's still bearish. So out of the 7 indicators, it is a bearish indicator. It's also probably the weakest. So out of the 7 indicators, I kept the weakest one for last. And that is this one. So out of the 7, 2 are bearish. 1 is the weakest. Maybe we can call that 1.5 bearish. And then we will have the other, I lost count now. The other 5 are bullish. The one I actually think has the strongest weighting to it is just really measuring the U.S. stock market against the U.S. bond market. And that's what we have right here. And it's going up. It's making new highs. So net of everything, guys, I'm watching it. There's always going to be something that doesn't look good. It's always going to be that way. But net of everything, the market looks good. Okay, I got one more thing I want to show you. And then I'm going to hit the pause button. And I'm going to call this China. So this is a price chart of the Shanghai Stock Exchange Composite Index. That's a mouthful. It's been incredibly volatile, violent, basically since 2007, if you look at the gray line on the screen. But if you're driving or listening to this, just know that it's at the same price it was at in April of 2007, also known as 14 years ago. So the Chinese stock market hasn't done anything in 14 years except scare the hell out of a lot of people. Now, this is a big experiment going on, right? China is cracking down on technology and internet and crypto companies in a very, very different way than the US and the West is. I don't know which one is better. In some ways, I like that China's saying, look, we think having a lot of centa billionaires or deca billionaires, probably not good for everyone. We'd like more of a middle class. So I like that they're doing that. Maybe the way they're going about it is a little brash, but who am I to judge China? The US just ripped themselves out of Afghanistan and have left tens of thousands of Afghanis who have supported our war efforts over the last 2 decades completely on their own. So I just want us to be very clear that whoever we are right now, I'm talking as a US citizen, pointing fingers to other countries, it's pretty easy to do. So we want to kind of look at what we do wrong too. But from an investment point of view, let's talk about China. I don't know what's going on right now because it's really in some ways hurting itself. But in other ways, if you look at the most recent part of this chart, it's not crashing. The Shanghai Stock Exchange Composite, it's not crashing. It's just going sideways. Right now, I can show you KWEB, which is the internet ETF of China. This is priced in US dollars, but please, a crash is a crash. This thing is down 50+%. Not looking good. We can look at China, the NASDAQ of China, and we can see a pretty scary thing happening too. So we know what they're doing, they being the CCP, the Chinese Communist Party. They're really saying, look, this has gotten out of control. We're getting on top of this now. it's easy for us to point fingers, us non-Chinese people, how they're doing it. The reason I brought in the way the U.S. has gotten out of Afghanistan is for any Americans listening to this, be easy on pointing fingers at other people. You got to look at your own country's government, right? I know I'm not talking to government people necessarily on the call. I'm talking to individuals who want to grow their money better. But having that perspective and having that humility is really important. But it is quite impressive that China has done nothing for 14 years while others say, let's just do this. Let's put in the rest of the world. Now, this VT total stock market, actually, we could do this MS World. Now, this is all world ex-US, but we can go back to 2007 itself. And even all world ex-US is up, drum roll, 8%. It's an index. So the world itself is up 8%. China is flat during that time period. If I were to put in, let's see if EZU is Europe. Now it's an index, so let me just take out dividends. So we can just look at this as an index. I can't do that, guys, because it had some splits. But here's EZU, which is a tracking symbol for Europe, and that's up 37% over the same time period. So we do know that other parts of the world have done well over the last 14 years. Let me do one more for you here, just for some reference here. Here's Japan right here. Japan from April 07 is up 43%. And big jump roll, just looking at the S&P since the April-ish of that same 07 year is up 300%. So this is really, in many ways, been a story of how the U.S. has allowed tech companies, both good and bad, to really dominate the world, right? 5 specific companies are really dominating the world, and they all are in the U.S. stock market. And that's one of the reasons why the U.S. stock market's up 300% over the last 14 years. Europe's up 40%. China's up 0%. Thanks, guys, for being in my world. I appreciate you watching these videos. Leave a comment. Tell me where I got it right, where I got it wrong. What triggered you, if anything? Be kind in the comments. I don't deal well with people dumping their rage. You'll just get kicked out. But let me know what you're thinking. And if you like the video, you're going to love our free course. It truly is free. Clarity and Control. You can check it out in the description. Something that I think everyone wants more of in their financial life. Thanks, guys. I appreciate you. I'll see you on the next video. Okay, bye.